Good morning. It is Sunday, the 26th day of March, 2017. Let's take a look at the Bitcoin market as well, talking about cryptocurrency volatility for the most part at the conclusion of this analysis, as the actual Bitcoin chart in itself provides a much lower form of volatility than most. The median in here, 3.33%, which is when silver is in a pretty decent state. That's what it's at. And silver, which is normally pretty volatile, is not. Cryptos are one of the most volatile things, and it's going to probably stay this way for most of the year, if not even beyond further. Okay, so as far as movement is concerned, let's take a look at the range from the most previous lower high and what's looking to be a lower low. And I say looking because if it immediately starts to drop, you got to get closer to the band to count this as the next high, thus confirmed low after the fact. But within this range, the key Fibonacci points we are in at 972 and that of 10 and a quarter, somewhere in this little range in here, which meets up with the 18 average of lows if it's able to come up towards a 61.8% from this point. The market is very bearish at this stage. It's got to make a move above this level. Long ways to go for it to regain its bullish mechanism. And any future moves lower that happen to occur on a break of this level of support, you're looking at the yearly lows now of roughly around the over 750 mark. Now, Fibonacci upside and downside within this range has the downside mark roughly at this same area of 774 and the upside target in at 1286. And basically what that means is when you see a clear break above this point, that's where your price objective is, and break below this point, price objective down towards this point. But for now, it's a test to come up towards this 18 average on a bullish level. There's nothing wrong with making a lower high, but the key would be nothing wrong with making a lower high, but it's got to make a higher low. And if it does such, say it does come up to say the 1025, 1030, 40 area, whatever, that's lower, comes back down, but it's higher, and then goes back up to that level, then that gives you decent odds of breaking it and momentum at that stage, which could make things a little more neutral, but definitely in the bear camp. Now, as far as the index in which I've created day number 13, not much to go over, but we can see down move, up move, down move, a little bit up, and it can go a decent amount up and still be in this type of downtrend. And the volatility, this thing started around 400, down close to 2, so you lose 40+% in a little under a couple weeks, and it's just a move because this includes currencies of crypto form like Dash, Ethereum, Litecoin, about 14, 15, 16, Monero, the best ones that, and really the only ones that I could find within the site that I'm using it. So now let's talk about individual cryptocurrencies and its volatility. And what I talked about yesterday was PivX, and this was last night. This is a 1 minute time frame. 1 minute. So before this big move happened, what you had in here was just a bunch of sideways action, and some of these, like, nothing's trading in here, small trade here, minuscule trade in here, no trade, a couple more minuscule ones, small sell here, Then they bought it back up a bit. Small buy orders are coming in. And then, of course, this big move. But notice the size of it. Over 7K down to a little over 5.5. That's a loss of about 20%. 20% loss in 1 second. So how does this happen? Well, the reason how this happens is because when one large person group of people decide, in this case, to sell everything or whatever large amount to this point, this can happen all at once. This could take millions and millions of dollars or however large amount it takes, but it can be done, and it was done. And then move back quickly. Now, why do these things rebound so fast? And the answer mathematically is very simple. See, before this happens, what you have is you have a whole bunch of sell orders above this level. You can't see the upper end, but they're there. And then you have a whole bunch of buy orders that are in. So this person takes every single one of these buy orders, and the immediate moment that person is done, in this case, the lowest or the highest buy order might now be something at like 55.07, maybe we'll say as an example. And yet the highest offer to sell might be in at somewhere like 70.14, because that's where it was the moment before the move. So now what's going to happen is people whom, well, before that happens, a whole bunch of people just bought shares, myself was included. So those whom are fast, what you would do is, oh, this just happened. Well, let's put in a sell order, say, and this is what I would have done and did do. Sell order here, here, maybe, and just wherever. And then wherever else above as well. Other people doing the same thing. Other people who have these sell orders 70.14 and above may reduce them. But what this results to is the amount of cost to bring this market up after a move of this nature is cheap. Dirt cheap. Because all of these sell orders that were executed within the rally after 2,300 hours was in a result of sell orders that were placed in only a few minutes, many seconds in time, which is why these situations occur. And when you got buy orders and sell orders in this type of nature, let's just say you had 12 buy orders in this range, and you also had another 12 down here as well. But with that being stated, you also had a couple dozen above this number as well. It doesn't matter if the move is like from this and coming back down or this coming back up. You're always going to get the play. Now, the way this strategy loses is if the market goes down, and pretty much always goes down and never ever gives you any type of bullish opportunity later on. That's the only way that this strategy is really going to hurt you. And I'm going to talk a lot about these risks within it at the more of the end of this. I'm already dragged this on close to 10 minutes, but I want to continue on further. I have a few more of these to show. This is a look at what the 30-minute chart looked like before March the 24th. And notice in here, you have a move. This is from over 9,000 down to over 5,000. So over half, or about half of its value. And the rebound was very quick, close to its previous high. But when you look at these moves and you look at playing in that situation, oh, buy order, buy order, buy order, buy order, buy order, however many you have. So all of them get filled. And then next thing you know, it's at the end of this period, you're like, wow, I got like 9 orders in, 6 of them, 7 in them for winning positions. You can sell a bunch now. Okay, let's sell. Oh, So you sold these three. Let's put more buy orders back in. Oh, they get filled. And even on this period here, whatever buy order you got here can be filled at the end of the period. And then all of these buy orders get filled here. The sell orders get filled here. Some buy orders are getting filled in there. So that's really the general way. And you need these volatile moves. And the more of these types of moves that can happen, the more ka-ching that it really works out towards the bankroll. Let's take a look at another example. And we can see here that around the 22nd, you have a move of about over 6,000. Very fast down to 39.99 and then back up again. So these moves are very much in play. Let's continue on further in the past, that is, to March the 20th. You see this period in here. How about this one? And obviously this one as well. And just its overall movements. How there's a lot of situations where you can get it. I mean, just look at the size of the moves. You're going from 3,000 up to like 37, 20% in a quarter day. Yeah, pretty decent volatility, I would state. And now let's take a look at this long term. Going back quite a while, this is a 1 week chart which has gained about 30% since it has broken past its area of resistance in here. So does it look toppy? Maybe. However, does it look like it could come back here? Well, that would be a normal retracement. We can see within, since this period, there was a small retracement here, but nothing to write home about. It's a correctionary single move here. It's sort of, when you see a move like this following a 2 big candle up phase, it gives you the a little bit more energy that could be needed to have yet another big green candle move that could go up 70, 100, 200%. Who knows, as so far the gains are 30. So you say, oh man, it's so scary, it's up 30 times. Yeah, it is. What was the case when it was up 12 times and 6 times and 9 times from the breakout, let alone from down here? What are they going to say if it goes up to 60, 80, 90, 200? And really, that's why when I want to talk about risk reward, where you're risking 100% of what you put in versus the reward, because if this thing just keeps going down, and well, you lose. There's your 100% risk. Let's put some more key elements within this. First thing, see the small green candle ending 2016. This one in here. It still had greater than 17% volatility within the week. That's decent volatility for any stock in a week. And this was its hardly moving period at all. So when you're looking for like minimum volatility that it's giving, well, there's a good number right there. And the last big one, this one in here, was about 8x, 700%. Once the numbers get so big, instead of using percents, I'll go like how many times higher or how many times it might lose its value. Huge risk reward. Risk, like I stated, is 100% if you are disciplined with not adding extra risk. For example, say this thing goes down and you're like, crap, I got to buy more. So you put more in and you put more buy orders here. Well, now your risk, if you put twice as much in, your risk is 200% now. Now that's one way of explaining it. But another thing is if you profit take, as you get little profits in, say you deposit 10 units and you've already, within profits, have already withdrew, say, 4. Well, now your risk is 60% of what you put in. And now the reward gains, which are by all means better than tremendous, to say the least, as you have situations where you can get 4x, 20x, 100x gains. And think of it in this perspective here. If the market gains, say, 5 times, And is it possible that you can double that or whatever times higher? And the answer is yes, because as I was showing, if they're having moves like this going on, oh, sell, 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 buy, buy, buy. Oh, sell, 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 and then buy, buy. If you could do that more often like that, then it's going to increase share sizes, increase profits, combination of the both, which is really what can get the job done. Now, as somebody that looks at gambling as a form of investing, risk versus reward, trying to find high probability, I've seen many different games that have been played in the past, whether it be games of sports wagering, games like poker, games like blackjack. There's even a few other ones that can do pretty decent. And even other ways of playing the stock market, Forex, and all those markets. There's definitely profit that can be had in those games. And obviously with all of them, it's always a lot of work. But that should go without saying. But this is the best one. The cryptocurrency trading for risk reward ROI potential for anything that I have ever seen before. And I think the opportunities for these type of wild volatile moves and even these situations just going back like this, they're not going to last that long. This is part of the origins of our new free market, I think anyway, where you got these types of moves. They happen in so many other different charts over and over. I've seen it happen a lot where you have these periods looking like this and then boom, because it went up fast and then it just went down. And the more of those that can occur within the trend, the better. Now you want to be playing markets that primarily are at least going to go sideways or up when you're doing it, because charts that go down can, well, limit your gains or make you even lose, of course, with downtrends. And markets that crash can kill your bet, kill your bet, the portion of the bankroll within it. And going straight up, well, buying and holding would be a lot more profitable, but you'll still get profits. And that will conclude it. Take care.